Ladies and gentlemen, good day and welcome to Camlin Fine Sciences Q2 and H1 FY26 earnings conference call hosted by InCred Equities. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and zero on your touchtone phone. Please note that the conference is being recorded. I now hand the conference over to Mr. Chaitya Doshi from InCred Equities. Thank you, and over to you, sir.
Thank you. On behalf of InCred Equities, I thank you all for joining the 2Q H1 FY26 earnings conference call of Camlin Fine Sciences Limited. From the management team, we have with us Mr. Ashish Dandekar, Chairman and Managing Director, Mr. Nirmal Momaya, Managing Director, and Mr. Santosh Parab, Chief Financial Officer. Before I hand over the call to the management team, I would like to draw your attention to the safe harbor statement in the investor presentation. Over to Mr. Ashish Dandekar, sir, for opening remarks. Thank you.
Thank you. Welcome, ladies and gentlemen, to this call. I know your time is precious, so we'll get on with it. Santosh will give you a brief of the quarter's performance, after which we will answer your questions. Santosh?
Yeah, thanks, Ashish. Good evening, everybody. Quickly to the financial statements. We had an around revenue of around 460 crores in this quarter, which is a growth of 8.6% over last quarter. The increase was fueled by the increase in straights and blends vertical of ours, where we grew our turnover in both the straights business of TBHQ, BHA, and also the blends business has increased during this quarter. As you know, aroma, the another vertical of ours, the volumes have increased. However, the net realization there has been subdued due to tariff situation. Overall costs are stable. In straights business, we have realization pressure because the prices are under pressure, even though costs have remained stable, especially the heightened local competition coming from local in the sense in India. There are competition coming on TBHQ, BHA. However, we have hold on to our volumes. Our volumes have increased this quarter by around 40%. This was mainly because last quarter, if you remember, we had a shutdown there. But we have come back on volumes in the states. Blends business has been growing at around 8%, which has grown by 8% in this quarter. Our margins have improved as compared to last quarter by around 2%. It's around 46% this quarter. It was 43-44% last quarter. Last quarter, we had certain shutdowns, and as the gross margins were impacted, this quarter, our Tarapur plant as well as the Dahej plant have been working at an optimum capacity utilization, and that has helped us to get back to 46% gross margin. Of course, we would have got more margins, but for the impact, the tariff pressure on the volume, vanillin realization. Vanillin business volume has increased almost by 35%. The sale volume has increased by 35% as compared to the last quarter. But the realizations have been under pressure, especially due to the 50% tariff which has been levied on Indian exports to US, and that has put pressure on the realizations. Costs have been stable. There's no increase in cost because the raw material price and crude prices have been under control. Coming to the other costs, if you remember, there was some one-time expenditure happening on employees' cost, but we had also said that we would be strengthening our blend team because we are looking at a lot of exciting prospects in our blends business, and hence we have been strengthening our employees especially in blends marketing employees almost in all our three regions of US and Brazil, even Europe, the new Vitafor acquisition in Belgium, in India. We have almost added 20 people this quarter also, and that's why the employee cost, despite being a one-time hit last year, has been remaining at the same level, and it will remain at this level now of this quarter. In fact, we have planned to add few more heads in marketing in various sub-verticals in those blends business. So there could be a small, some percentage increase in employee costs going forward. As well as other costs other expenses are concerned, there also we had to absorb fixed costs in the last quarter because of the closure of shutdown of the plant. But this time the volumes are higher, as I said. Volumes in Tarapur plant were almost more than 40%. Even Camlin plant, we had additional 35%. Our plant was working between 50 to 60% Camlin. Obviously, that has brought the other costs. And the end result was an EBITDA of around 33 crores this quarter at 7.27% as against 2019 odd crores in last quarter. There's an increase, but as I said, margins on cost side, we have been fairly stable, but for the bench strength, which we have increased in employee cost. However, there are certain pressures on the realizable values of our products. Our blends business sectorally remains exciting and good. We are growing. Of course, in US is a geography where we have seen certain sluggishness, especially which was also due to the inflationary thing in US. But we are certain that we'll get back to the original levels, and we will be able to achieve the generally budgeted thing of growing at around 18 to 20% on blends year to year. This will be supported by the bench strength which we are increasing, as well as inorganic growth. We had just are on the verge of issuing swapping shares with new acquisition in France. That will also come. It will become a subsidiary sometime in this quarter, which will bring additional revenue. So we feel that we are on track for the growth which we have been saying in blends. Coming down to the profit, yes, we had a loss last quarter because of the shutdowns and other things, but we had it's almost zero, and it will improve as we go to the subsequent quarter. As far as loan book, coming down to the balance sheet, we didn't have any big fixed assets expenditure apart from what we had to do for maintenance and other things. Our gross debt situation has remained stable. It was around 645, it is 640. We did repay certain loans, but as we have been always saying that this repayment we have to go for working capital also because your revenue keeps on increasing. The net debt was 490, it has been at 520. That's basically we had some right issue money which has been used. But largely the gross debt is expected to remain at the same level. Correspondingly, if you see interest cost has not gone up much, net of fixed cost, we have been at the same level. So all in all, we are in increasing trend despite all the issues of tariff and the struggle on the realization. We are making on a growth path, and I think this path will remain as the year progresses. Yeah. Thank you. You can open the question floor. Thanks.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all the participants that you may press star and one to ask a question. The first question is from the line of Rehan from Coherent Wealth. Please go ahead.
Hi, am I audible?
Yes, we can hear you.
Thanks.
Loud and clear.
Thank you. First of all, I just had a couple of questions. In the Q1 Concall, you had mentioned we have about 3 to 4 months of channel inventory for vanillin. And I see on QOQ basis, you've done really well in a challenging time. So kudos to you guys for that. Could you help us understand how is the channel looking currently at the moment? Is the destocking complete? That's my first question.
The destocking in the US is expected to be completed by Q4 of this year. And in Europe, it is expected to be cleared by Q1 of FY27 because Europe, the anti-dumping duty was levied only in July. So there was a large amount of channel stocks lying in Europe.
Understood. Because on the Q1 con call, you had mentioned you're expecting by November to be cleared the entire channel. So are we seeing a delay on that?
Yeah, I think so. I mean, there is also the effect of tariffs, which has played a role on overall demand in the US, which is now opening up. So we expect by Q1 for it to be the channel stocks to be empty, and we get a good position in the market.
And just for this quarter, what would have been your blended realization? Around $12-13?
Around $12, yeah.
$12 is sale price, and the net price, net of freight and other things which we have bought, it's between 11 and 12.
Understood. So, sir, I wanted to confirm on that year on year, if we look, not quarter and quarter, because I understand you took the plant shutdown. If we look at it year on year, your sales have improved by about 8-9% for the quarter, out of which vanillin has improved specifically by about 70-75% year on year. But still, your gross margin is down about 200 bips. So, I mean, it just doesn't. Just wanted to understand more on that.
So last year, I've been mentioning that there is certainly a price pressure here. In last year's trades, like TBHQ and BHA was being sold at $8.5 and $9. The prices have come down to $7. Similarly, vanillin, the situation was totally different. We were hardly producing at that moment of time. But generally, the margins are lower. The cost have almost remained same year on year. But the whole trouble is the realizable pricing is under pressure. And that has taken out around 2 to 3% of our margins. Quarter on quarter last year.
And considering that Europe now scheduled their fresh contracts for vanillin, are we seeing 15-16 kind of realization is what, has been the historical median? So are we seeing those kind of prices and contracts coming in for us?
No, not in Europe, not as yet. Like I said, in Europe, the channel stocks will remain till end of the year, till March at least. So the price realization is in the $12-13. But we will see it move once the channel stocks are empty.
And do you feel you are confident of reiterating your guidance for about 2,500 to 3,000 tons this year for vanillin and also blends? Because on H1 YOY basis, you're about 7-8% kind of growth. So do you think you guys are going to stick to that for this year, considering the tariff headwind and, other macro factors?
I think vanillin, we are, how much have we done?
For the half year, we have done almost 1,300 tons.
1,000?
300 tons.
1,300. So, yeah, so we are good for the 2,500.
Okay.
And for the blends also, we are the 20% that we are saying between 18 to 20%. I think we are okay for that as well.
Okay, because in H1 basis, you're still at high single digits. So you feel that will cover up in H2?
Yes. Also, there is an acquisition which will add some numbers.
Okay, so that includes that 18-20%.
Yes. Yeah.
Okay. Thank you so much. Thank you.
Thank you. The next question is from the line of Satish Kumar from InCred Capital. Please go ahead.
Hi, sir. So I just wanted to ask one thing. This is regarding the guidance that was there of around 2,000 to 2,100 crores kind of sales. Whether that will be achieved or are we changing it?
No, that will be on, they're online for about 2,000 to 2,100.
And sir, also, what will be the current prices, the retail prices of vanillin in US?
In US, the prices are, minimum is $19. But they're seeing now some businesses even at 20 plus.
Okay. So, assuming, sir, that if Trump tariff comes down to 15%, what we can realize, sir? I mean, I'm not asking for a guidance, sir. I'm asking a rough idea.
No, so the pricing I don't think will come below that because the local competition that we have is pricing it at around the same $20 price.
Yeah.
So our realization should improve by at least $3-4 of, whatever, depending on the tariff situation, what it lands at.
Okay. Got it, sir. Got it. And sir, also wanted to understand regarding WinFi. When will the integration happen, sir?
So we are expecting it by November end. It should be we're just waiting for approvals from stock exchanges for the swap. And once that is done, within 15 days, we will do the swap. So by end of November, it should be done.
So we will start consolidating it from this quarter,
Correct.
from 1 month.
Correct.
Okay, sir. That's all from my side, sir. Thanks. Thank you, sir.
The next question is from the line of Surya Narayan Patra from Phillip Capital India Private Limited. Please go ahead.
Yeah. Hello. Yeah. Thanks for this opportunity, sir. My first question is on the US business. So the North American business sequentially has seen a kind of impact. So what is this business getting impacted? So is it the export from India or it is the pricing or it is the tariff? What is really getting impacted here?
So in the US, the one impact that had happened was there was a bit of a slowdown in the pet food business in the last 2 quarters, which now seems to have improved and is picking up again. So structurally, the naturals that we are selling into the US was getting replaced by some synthetic at a lower end of the market. So which I think again now they're back on track and we should be back on track on the US.
Surya, to add to what Nirmal is saying, we had been selling vanillin through US. So 96 crores of revenue last quarter also had vanillin. Now if we import, then we have to bear the duty first that impacts our working capital. So in this quarter, we have tried to do direct sales rather than routing it through US. So the dip of 96 to 69 is not only of blends. There is reduction because of vanillin. Blends, it's not gone down. It's like 5% small on animal nutrition and other things. Because the turnover is shown of entire, in earlier times, there was no vanillin sold in US, so it was very pretty safe to assume that it was blends. But now the case is different, at least for this quarter. Last quarter, there was vanillin sale in US because we are selling through US to get better margins. Now, to circumvent the working capital requirement and the vanillin to be the duty on us, we are directly selling.
Okay. So, hypothetically, just I wanted to understand. We know that the historical average for vanilla is been, in terms of pricing, is been in the range of around $12 kind of. So, what we are currently getting even for the US market right now, even after the tariffs. So, if this tariff situation continues like that for, let's say, extended period, so then what will really restrict us from enhancing and expanding the volume?
No, so Surya, the point is that the volumes were impacted, as we said, was because of the channel stock. Once the channel stock is cleared, irrespective of what the tariffs land at, whether they continue at the same or they come down. If they go up from where it is, of course, our net realization will get impacted because the final price in the market is around $20. Now,
Correct.
our net realization today is $12 because of the tariff in between.
Yes.
So it's really a calculation is now really where the tariffs will land at. If they go more than 55, this will come down, net realization. If it comes below 55, our net realization will go up.
Just to add also to this, if the prices remain at 12, channel stocks are out, we will be increasing our production, say, to much more. As you know, we are running at 50%, so the cost is higher. So we may be saving around $1.5. If we go on 100% with $12 realization only, there will be some margin improvement, though not the turnover doesn't increase. But as Nirmal said, the tariff situation is different. There will be a much higher margin increase.
Correct. Yes. No, fine.
The way to look at it, Surya, the way to look at it is all our costs of running the vanillin plant are in today. Whatever incremental sales that I do on vanillin will my RMC today is say at roughly about $8. So and if my realization is 12, I get a straight $4 margin on every incremental sale that I do because in these numbers all my costs today are in 100% of the costs are in.
Yes. So then it is a question that when the on ground demand will really pick up.
Correct.
After
that is the question
of the inventory.
Correct. That is the real question. And for that, our expectation is by Q4 it should start picking up in the US and Q1 in Europe.
Okay. And about the non-US, non-Europe market, what is the trend and what dynamic that you are seeing, sir, for vanillin?
Trend is very bad because the Chinese are desperate, selling at $7, $7.50. So it's not really a market that you can play in. But of course, we do have some markets where, especially in F&B, where we do sell small volumes, and we are yet focusing on those markets and trying to build small. It will not be very large volume, but whatever we do get is always it always has.
Okay. My next question was about the blends business. So, if I remember the last time that you have been mentioning about creating the franchisee, the branded franchisee in the blends in the advanced markets. And today in the opening remark also it has been mentioned that there is a field force expansion likely.
Right.
So if you can, sir, give some sense that what is the field force that you are currently having for the blends business, what you are currently having, and what metrics that you do follow in terms of revenue per sales representative or something like that.
Sure.
And what is the field force you are expanding, and what timeline that would be required to achieve a optimal kind of revenue per representative on that front?
So in every market, Surya, the metrics is different because every geography, the cost structures are very different. So we can't really generalize and say that, our metrics is in the US is very different than it is in India. It's very different in Mexico as compared to Brazil. So it's again market to market. However, on the number of people, I mean, we have expanded the field force by almost 31 people in this quarter. Starting, in this last quarter, which the impact of that we will start seeing from. Typically, it takes 6 months for the impact to start showing once somebody is onboarded. So you will start seeing the impact of this additional by Q4 and Q1 of next year. However, we had also added people, say 6 months ago. Also in Q1, we had added a few people. So that will also start showing results from Q4 onwards.
So that means, is it fair to say, sir, this is a 10%, 20% kind of field force expansion, or in what, any numerical sense, if you can
No,
provide?
it's more than 10%. It's almost, I think we were at 21% increase in field force.
Oh. And hence, accordingly, the employee cost will see a kind of a swing to the tune of, let's say, 5-7% incremental.
So yeah,
next
so it's
year.
already you've seen this quarter what this is. Beyond this, there will be a little bit more than that by the next quarter because we are also adding a few more people. But more or less, it will be on these lines, and that's why we are projecting by adding 20% sales force, we are projecting at least 20% growth in the next year.
Partner, just to add to this, there is no, you are not observing any increase in the employee cost because there was a one-time bonus which we had given last quarter. So this increase in employee cost is getting hidden because of that. So if we have added people and salaries have increased. In fact, if there was a one-time in first quarter, my salary should have gone down. It has not gone down because we are adding people.
Okay. Just last one point, sir, from my side. See, we know that there is a kind of over inventory for vanilla, both in US and Europe. But we also know that this is the time that by December we sign the contracts for the next full year. So on that point, what feedback that you are getting, whether there is demand, people are...
No, so right now, people are not signing for the full year. Typical contracts are for 1 quarter or 2 quarters because they have some stocks also and some contracts spilled over. So that is the reason why it is very difficult to gauge what ultimately that volume will turn into. But yes, the indication is, I mean, we did win some contracts for the next first half of the next year, all at these prices that we are discussing. And we are also kind of happy that it doesn't go on. The contract shouldn't be too long because if there are any changes in the tariffs or whatever, we need to be careful on how we are quoting.
So that means if the tariff situation eases, then our first target would be spot market rather than the contractual supplies.
No, I mean, no. We have in the contract it is DDP price, right?
Okay.
So for us, we are taking those contracts. It's not that we are not. We are signing up as we are bidding, and we've also got some contracts already. The bids we have won for H1 of next calendar year. So there will be a strong. We will tie up for the H1 a decent volume through contracts, and of course, then the rest is the spot market.
Okay. Yeah. Sure, sir. Thank you. Wish you all the best.
Thanks.
Thank you. The next question is from the line of Raj Agarwal from CJ Shah Family Office. Please go ahead.
Hello. Am I audible?
Yes.
Yes. Sir, I just wanted to understand on this European business. So what are our plans for this business? And by when will these losses, even now in discontinued operation, but like how long will this continue?
So as we have been saying that we have mothballed the diphenol plant and we are trying to revive the blends business in Europe. On an average, we should have 5-6 crores of quarterly hit. There are some expenditures which get spilled over in the quarters. So last quarter it was 5, it has become 8. But on an average for the year, it will be around 25 odd crores. Going forward, next year onwards, it will come down to 2 crores per quarter. This quarter it will be there. So this cost will be there for this discontinued business. We also have other discontinued business of China, which has a cost of around 1 crore of this, crore rupees cost, which we have already initiated liquidation proceeding. Then there will be no cost going from FY27.
Okay, sir. Thank you. This was helpful. And sir, one more question. Sir, have we signed any contracts at this kind of prices for next year as well, or basically we are only signing these contracts till the channel inventory is there in the system?
So we have signed some contracts for H1, calendar year 27. So 26.
And that is at this prices, roughly
Yeah.
$12 prices?
Yeah. No,
Okay.
it's BDP. It's BDP price, which is at around $19.5.
Okay. And basically because...
Yeah.
Yeah. Okay. Got it, sir. Thank you so much, sir. These were my questions.
Thank you. A reminder to all the participants that you may press star and one to ask a question. The next question is from the line of Rohan Mehta from Concall Family Office. Please go ahead.
Hi. Thank you so much for the opportunity. Am I audible?
Yes.
Okay, perfect. So firstly, I want to understand what sort of trends are you observing? Okay, first in the month of October and currently ongoing for the month of November when it comes to vanillin. In terms of the offtake that you're seeing and also in terms of the pricing. So is the pricing more comparable to the softness you have observed in Q2, or are you seeing prices slightly go up?
It's the same. We answered that question. We're seeing the prices at the levels that we've seen in the past. The DDP price in the US is around the $19-20, and in Europe it is $12 to $13.
The volume trend also remains. We have done around 700 tons in this quarter.
In October, November also it will continue on similar lines.
Similar.
Okay. And in terms of your vanillin mix, so last quarter you had guided that Europe is going to be 40% of the mix. So given that there is uncertainty when it comes to Trump tariffs, are you looking to shift more of this to Europe, increase your revenue mix over there? Is there any change in strategy?
No change in strategy at this point of time. We're continuing with the same strategy because US is a bigger market, so it'll always have a bigger share in the total mix. So with the Trump tariff also, ultimately we have a lot of capacity which we need to fill up first. So once we fill up the capacity, we have to see on what the final strategy will be.
There are channel stocks also in Europe.
Right. And lastly, on Senesco restarting their synthetic vanillin unit in France, I wanted to understand, has it to some extent cannibalized your sales in Europe, considering that now there is an additional capacity coming up online that can actually service the clients in Europe? Or do you feel that you will still be able to push up the volumes which you were on track to guide?
They have a capacity of 5,000 tons. In Europe, the market is about 8 to 8,500 tons. So there's a gap of 3,500 tons to be filled from imports into Europe, which is what we are trying to position ourselves to fill.
Okay. Thank you so much. I'll get back in the line for more questions.
Thank you. The next question is from the line of Satish Kumar from InCred Capital. Please go ahead.
Thank you for taking my question again, sir. So I just wanted to ask regarding the salespeople. When you are hiring them, they will be doing the sales for WinFi as well, or you want to hire separately for WinFi?
No. So they do for all the whole basket of products. And of course, for WinFi itself will also hire more people as we go along. But at this point of time, the 31 that we've added does work on different verticals. There is pet food, there is animal nutrition, there is human food. As far as the human food team is concerned, they sell even the WinFi products.
Oh, got it, sir. I just wanted to ask on the WinFi itself. So what is the revenue right now, sir? And monthly run rate of revenue in WinFi?
They are at about 1 million plus euros per month.
Okay.
Current fund.
And
yeah.
Okay. And sir, in Europe also, we signed the contract for vanillin on the delivered to client basis, right, sir?
Yes.
Okay. So means all the tariff, freight, etc., whatever it is in Europe as well as the US has to be borne by us.
Correct.
Yes.
Okay. So $20 that we have signed for next year, 19.5, 20, what you said, sir?
No, that's for US market. That's for US market, not for Europe. Yeah. The same customer has different prices for different markets.
Right. Right. So this is delivered to customer in US.
Yes.
Okay. Thanks, sir. Thank you.
Yeah.
Thank you. The next question is from the line of Neeraj from White Pine Investment Management Private Limited. Please go ahead.
Sir, thank you for the opportunity. Only two questions. One, if the local market US pricing is, say, $12, how much would we net realize after whatever adjustments we have for all the logistics, taxation, etc.?
So net realization itself $11-12. The selling price in US is $18-19.
I'm talking of Europe. I'm talking of Europe. So if
Europe
also
we are getting the same realization.
Net
realization is in the same level as US. US should have been more, but for the duty, higher duty in US. We have the net realization in Europe is also $11-12.
Okay. The second question is, if tomorrow, say, the tariff is reduced in whatever number, so after how many days will you start getting that realization because the contract you have signed as $12, or is it like the moment the import duty goes to, say, a 15% or 20%, your realization will increase this next day itself? So wanted to know that delay.
It will be on how the duty is reduced by the US government.
But when the So that I understand, how many days delay will it come to you, that money? For example, if the tariff is reduced to, say, 20% on, say, 15th of November, now you have signed contracts with the customer already for a quarter down the line. So will you get $12?
So yeah, it depends on whether the contract is CIF or it is
right,
DDP.
Right.
Or it's DDP. So based on that, if it's DDP, it's the next day you get it. If it's CIF, till the next time the contract comes up, you have to continue to price it at the same price.
Okay. The question is, what are our contracts, CIF or the other one?
No, it's a combination. Some are CIF, some are DDP.
Major DDP.
So the full impact of, even if the tariff is reduced today, the full impact will be at least a quarter.
No, on the DDP contract, it will be easier.
Yeah, but that is partial, right? Because some contracts are CIF. So until you have completed the CIF contract, your next lot realization will be only higher, right? The same lot will be higher. Am I right?
Yes.
And what is the maximum outward contract you have signed?
No, that is confidential. Yeah, we can't give you those numbers.
Okay. No, I was trying to see, only thing I was trying to see is, if the tariff is reduced, by how many days or months will your full realization be coming to you? That's the only thing I wanted to know.
Yeah.
Okay, got it. Thank you. Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Aditya from Polylab Family Office. Please go ahead, sir.
Hi, am I audible?
Yes.
So my question is regarding the Dahej facility ramp-up. So we commercialized the Dahej ethanol facility, and it was expected to yield us an incremental EBITDA of about 60 to 70 crores at a full capacity realization, and at a cost advantage of maybe $1 to $1.50 per kg. So can you just give me the current status of the current utilization rate and the incremental EBITDA that we are doing?
I can tell you what is the current utilization, and I said that it's around 50, it's 50 to 55%. We sold around 700 metric tons. Our capacity is 6,000 per annum. That's around 50% capacity utilization. At that utilization, our costs are 9.5, 10. At full capacity, it will come to $8.
Okay. And that will eventually give some EBITDA margin improvement, let's say in FY27 when all the...
That's a multiplier. I've told you the number. The whole thing is the realizable value. It's a multiplier. You can multiply it.
Got it. Okay. That is also my side. Thank you.
Thank you. Ladies and gentlemen, the next question is from the line of Satish Kumar from InCred Capital. Please go ahead.
The last question on my side. Will you be giving any guidance for next year, sir? In the terms of vanillin sales or blend sales?
Yeah. So vanillin, I think we should be looking at about 4,000 tons in the next year. And the blends business also, we are looking at growing it by 20%. So these are the two big drivers of growth for the next year.
That's all. Thank you, sir. Thanks a lot.
Yeah, right.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand over the conference to the management for closing comments.
Thank you. Thank you for being with us, ladies and gentlemen. We look forward to interacting with you for the next call next quarter. Thank you.
Thank you. On behalf of Camlin Fine Sciences and InCred Equities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.